On that note, let's welcome in our next guest. Rupen Rajguru, Head of Equity Investments and Strategy at Julius Baer, is with us now. Rupen, thanks for joining us on the show. Hope you've been keeping well. And first, simple question. The market has been marching forward, expecting a very sharp, quick recovery as the unlock continues around the country. Is the market getting it right?
First of all, good afternoon, Surbi, and to all your viewers. Yes, the big theme right now, Surbi, that what market is thinking is a economic recovery. And at a big picture level, if I were to look in from a global perspective, no, we are in for some growth which we haven't seen for decades, right? US is talking about 7% growth. So the bull market was born in the amidst the bottom of the pessimism last year, which was probably government-induced recession globally because government lockdown across the globe, and hence we went into recession, and extraordinary measures which the government as well as central bank coordinated together took, and hence this is what we are seeing. So if I were to just draw a corollary, like in COVID, people or patients were treated with steroids, the economy was also treated with liquidity steroids and fiscal stimulus steroids. We have to wait and see. We have seen some side effects in patients, be it some other black fungus or something other. So let's wait and see how the economy comes out of this steroids induced by the central bankers as well as the governments across the world.
Okay, fair point. Now, Rupen, good afternoon. So in that case, what's your portfolio approach? What kind of stocks are you buying in India right now?
See, from an India perspective, we probably between the central bankers and the government, our central bank went on overdrive and did whatever it could as far as liquidity is concerned. And I think the toolkit which our central bank here has adopted, that we don't want a liquidity event. Because we all recollect in 2018 we had a big liquidity event or one credit event which led to a liquidity event and probably which led to solvency event in a lot of the companies. So the liquidity was induced. So while we also, our economy went down and when we have recovered sharply, and from our perspective, from our portfolio perspective, to answer your question, Anuj, we are playing in the economic sensitive sectors, beginning with financials. Also some of the other early cyclicals which can be cement, which can be industrials. We are positive on the overall private capex cycle as well. So some of the early cyclicals, as I said, is something in which we are positive. While we are cognizant of the fact that if there is any global event, which I think everybody has been speculating so far, then we want to also balance our portfolio with some of the global or exporters. So while we are neutral, but we are now kind of turning a little bit positive towards some of the exporters, which would essentially be healthcare and IT. So to sum up, our portfolios are economic sensitive sectors along with the early cyclicals and a little bit of exporters. So that's the kind of sectors at which we are positive.
Okay, fair enough. Where does that leave the consumer sector, Rupen? Because the whole bet is that very quickly there will be pent up demand. We all want to go out, eat, drink, shop, etc., fly, travel. But do you subscribe to that theory, and how are you looking at consumers?
See, consumer is split into two parts. One is the discretionary side of consumption and another is the staples. So there again, we have to have a different lens in looking into these two sectors. So while staples might have a little bit of hit because of the second wave of COVID, especially the rural side of demand, but those are very solid companies with very strong cash flow generation. So those are probably the staples I would say are hiding place. So if tomorrow world goes through huge volatility and if there is a big downside in the markets, probably staples would be a good place to hide. Whereas on the discretionary side, at a margin, we are kind of positive. While we were increasingly looking into data points and are now getting more confident. At least some of the auto companies have increased their pricing, indicating that they have reasonable amount of confidence as far as sales is concerned. So that on the discretionary side, we are tad positive. However, on the staple side, we are kind of neutral to negative, and more so because of the valuation rather than anything else. And just a point here, yesterday in HUL's annual meeting, the chairman did indicate that the rural demand is quite resilient. While they had some blip temporarily, but he indicated the demand is quite stable out there. So net on a consumer staple side, we are kind of slightly more negative, more so from a valuation perspective, and on the discretionary side, we are kind of having neutral to positive stance.
What's your view on this PSU rally, and how do you approach it? Are you buying any stocks here?
We don't kind of box entire PSU into one bracket. While we like some of the PSUs who are undisputed leader in their segment, be it in the financial space, not because they are PSU, but because overall the way that company is run, and at least they are increasingly also mindful of minority shareholder returns. So while we like some of the other leaders on the utility space as well, because Anuj, the big debate globally which is right now going is the classic growth versus value trade, and at a margin all of these PSUs will fall under the value bucket, and these value bucket tend to do well when there is an economic cycle, because when the assumption is that these companies are not growing enough. So if we are going through an economic cycle, definitely there will be a catching up there. So as a segment, we don't brand PSU as one segment, but within that we are kind of constructive on some of the companies. So we don't have a blanket no to a PSU, or no, we like it as a basket. We are selective amongst that, and as I said, in some of the selective sectors on the utility side or on the banking side, we are constructive.
Okay, on the whole capex/industrial theme, Rupen, if you could just give us some more color on that. So, I mean, across the board, are you playing capital goods companies, or how are you cutting it? This whole recovery in private capex that everyone's been waiting for.
It's a pretty important and interesting question, Surabhi. Before I get into how we played, see, one important data point which we all have to be kind of aware of is that we ended the year FY21 with the corporates having the best ever balance sheet. Okay, if you see the operating cash flows overall of India Inc. Has been one of the highest in last FY21, right? In last 2 years, because of lower interest rate as well as reduced tax rates, there has been some back of the envelope calculation close to 1.5 to 2 lakh crores of savings which the corporates have done. So here we are seeing some signs of the capex picking up. PLI schemes of the government has also helped. So the way we are playing, as I said, the early cyclicals, which would include some of the industrials, capital goods. While some of the valuations are not particularly very cheap optically there, but we have seen it in the past that when there is this industrial cycles, these early players like industrials and capital goods companies, they tend to significantly outperform as far as their revenues and profitability is concerned. So these are the sectors which we look through within that. And as I said, the balance sheet of corporate is the best. And just one more additional data point, just to give which gives us confidence that this cycle is definitely recovering. But the largest private sector bank, probably what are they betting? They are betting on the working cycle lending, as well as they are betting on the SME cycle, right? So SME. So that's the two areas in which at least categorically they have said that they are focusing, and they are pretty positive. So that gives us confidence that this cycle is kind of clearly going to be emerging much stronger over the next 1 to 2 years.
All right, Rupen, it's been a pleasure talking to you. Thank you for joining in and giving us some sense and perspective on how you're looking at the Indian market at this point in time. That's a view from Julius Baer coming through. And with that, we get back to the screen, and the screen is actually continuing